CNBC TV18.
Good afternoon and welcome to MF Corner. I'm Sumaira Abdi. Well, two big topics are being spoken about today. The first one is what should be your investment strategy in an environment where we are seeing a fall in interest rates and slowing economic growth. Anshu Kapoor, the head of Edelweiss Private Wealth Management, will join in to talk about what they're exploring with their clients. And also a little later on the show, a very interesting topic, the investing habits or investing preferences of the young and the restless, the millennials. Joining in will be Harsh Jain, co-founder and COO of Grow.in. So we'll have that for you on the show, but first let me kick start it with Anshu. Hi Anshu, good afternoon. You know, we're seeing all across the globe there are murmurs that economic growth is going to take a hit. Interest rates, of course, on the lower side, but the market seems to have a mind of its own. So what do the investors do? Do they look at the market for inspiration and, sort of continue with their investment strategy, or they stop and ponder about, where the world is going, where the Indian economy is going, and therefore change tracks?
Good afternoon, Sumaira. Great to be back on your show. Yes, as you rightly said, there seems to be a little bit of divergence between the real world, the economic situations, and the financial world. And as I said on the last time I was with you, investors need to be very careful, because we know that there's a lot of liquidity-led inflow that is coming into the market. Is at least on the equity side, we are seeing a lot of this maybe froth building up. And therefore, caution is the word. I would really advise clients, investors to be cautious, stagger the investments out, do not venture into something that they do not understand, and overall give it time. This is not a T20 game, it's a test match. This is your hard-earned money. So do not get pulled in by, if the markets are going up 5, 7, 10% in a very short period of time, do not feel that you're missing out. Just time yourself, see you're on track, see your own objectives, and keep assessing your portfolios. You have all the time in the world. Economic cycles come and go, so therefore you are not going to lose out too much. Just give it time, as I can say.
Okay, Anshu, for retail investors, they somehow manage to understand the equity side of investing, there is a lot of information also available, but it's the debt side that almost, confuses, confounds them. So on the fixed income side, what should investors do at the moment? I've heard a lot of wealth managers, and I heard you refer to it also right now, is keep it simple. So how do you keep it simple on the debt side?
Right, and you're absolutely right, Sumaira. Debt markets, so fixed income is the biggest asset class in the country. Over 50% of India's household wealth is invested in fixed income. So if India's household wealth is about 240 trillion rupees, about 120 trillion is in fixed income. And we do not talk about it a lot more, as much as we should be. And yeah, you're right, investors have been very passive about their fixed income investments. First let me build the context, and then we will maybe go towards as to what we can do, what opportunities are out there. Number one, recognize that interest rates are falling. We are in a very different scenario from maybe 3 years back or even 1 year back. From an inflation perspective, from a GDP growth perspective, from an economic cycle perspective, we may be headed into a structurally going down or declining interest rate scenario, right? So that is one input to absorb for all our investors out there. Interest rates could look meaningfully different even 6 months down the line. If you have not acted on your fixed income portfolios, this is the time to act now. Number one, please review your portfolios. Please see, first of all, be aware what's out there. What is the time horizon for what you blocked your money? What is the risk out there? Do know what you're carrying in your portfolio, and then try and make amends, then try and make decisions as to what needs to be done. One more data point for all of us to recognize: of all the fixed income debt funds or the debt mutual funds, more than 50% of them are maturing in 1 year. So overall, as investors, I don't think we've paid attention. We've been very passive, as I said earlier. We've not really paid attention to where our money is being deployed in fixed income. So what's going to come to you as a challenge or as a risk is that when your money is mature, you will be scampering to find what other avenues could be, right? And also the number two thing is, if you assume there is safety in anything that is called debt mutual fund or fixed income, you need to again revalidate that, right? And if I may extend my conversation with you, Sumaira, on this one, the way to do this is to ladder your investments. And I'm trying to keep it very simple. What does laddering mean? So you need to know of how much money you need to park for or invest for maybe up to 30 days for your liquidity cushion. You need to be very clear as to how much money you will need in up to a year or 2 years, and how much can you really lock in beyond 3 years. And lock in is the emphasis, the key word. As much as you can lock in over 3 years or 2 years, given your cash flow needs, given your investment horizon, lock in yields now before they fall further. Lock in into something that you feel safe, confident about, and also lock into something that where you have predictable cash flows coming in. So I'm going to pause here, Sumaira, if you have more questions, and we can obviously dive into what investment avenues could be out there.
We're a little out of time, Anshu, so I'm going to speed through some of your recommendations. You have, of course, Bharat Bond, you have PSU bonds, debt mutual funds. Now, these are some of the better known avenues. I want to talk to you about this AAA market-linked debentures that you recommend. How feasible is it for retail investors? And the other one being this recommendation of InvITs and REITs. So if you can explain your rationale behind why you would recommend two of these to retail investors, what's the safety factor, what can they really expect?
Right, so all forms of PSU bonds or high quality bonds perhaps will fall in the bucket or the ladder above 3 years, right? It could be a REC bond or a PFC bond or a SBI or a Bank of Baroda kind of a perpetual bond. So that is one category that investors need to look at. The other category is a category called market-linked debentures or structured products that will give you a kind of a predictable cash flow and also are tax efficient. So the tax on these are only 10% above 12 months, and they're fairly, there are fair amount of well-known AAA names to choose from, and your yields will be between 6 to 7% here, Sumaira. The last category and a new category that has come up for investors to look at is something called an InvIT, right? And just to simplify what an InvIT does, it pools in operating assets, let's say transmission lines, where the counterparty could be Power Grid Corporation, and you are able to get a yield as high as 10 to 11%, but know how much you want to invest in that. And the last category that you spoke of is the real estate investment trust, a new product innovation that has come in, where you're able to invest into a pool of commercial real estate assets. And again, most of these assets are leased out to what we call very high quality tenants, so to speak. So these are all office buildings you can end up owning, and your yields could be anywhere between 6 to 7% pre-tax with some possible appreciation. So these are fairly predictable cash flows where you can lock in yields or returns more than 3 years.
All right, Anshu, thanks very much for joining in. We're going to schedule another interview soon, perhaps in non-earnings season, and get more out of what these mean for retail investors. For the moment, thanks for your time. With that, we'll take a very quick break. Up next, we have a very interesting chat lined up on the investment preferences of the millennials. What are the mutual fund categories that they are choosing? Harsh Jain, co-founder and COO of Grow.in, joins us next. Stay tuned.